Welcome to the channel. We have a very important topic to discuss today, and that is the foreign investment playbook, risk versus reward. We will examine where the capital is safe and the science of investment friendly nations. To discuss all these, we shall also elaborate the importance of corruption perception index, rule of law index, human development index, fragile state index, ease of doing business, and cost of doing a business to explain this topic in detail. Let's move forward. The foreign, foreign, foreign investment playbook. There are certain indices which are mentioned, say, by the World Bank or other institutions, which provide information as to whether a country is investment friendly or not. For example, we mention few: corruption perception index, rule of law index, human development index, fragile state index, ease of doing business, and finally the cost of doing a business, etc., etc. Global institutions like the World Bank, the World Economic Forum, and the United Nations track a specific set of international indices to measure a country's investment friendliness. The famous Ease of Doing Business Index by the World Bank was actually discontinued. It has been replaced by a much more comprehensive, modern corporate flagship index, and that is Business Ready Index, which factors in things like, as on today, the digital development, environment sustainability, and operational efficiency. ये indices क्या हैं? They are categorized by the specific type of information they provide to a potential investor. First one is a corruption perception index, and that is the under the title of governance, law, and institutional integrity. It is published by Transparency International. What it measures, it scores countries based on how corrupt their public sector is perceived by the experts and business people. Why investors care about corruption perception index? Because high corruption function has an unpredictable hidden tax. If a company has to pay bribes just to get standard permits, it destroys financial forecasting and exposes the parent company to massive legal penalties at home, like the US Foreign Corrupt Practices Act. The second important index under the governance, law, and institutional integrity is क्या है? बहुत important, and that is Rule of Law Index. It is published by World Justice Project. ये क्या measure करता है? क्या बताता है? It evaluates whether laws are publicly stated, equally enforced, and independently educated. These factors include constraint on government powers, absence of corruption, fundamental rights, and regulatory enforcement. Why investment? The potential investor care about rule of law index because it is a legal sheet. If a dispute arises between a foreign corporation and a local partner or the local government, the foreign investor needs to know the courts are unbiased and will enforce contracts fairly rather than favoring local entities. Business Ready Index under the category of operational and business climate. It was previously called as Ease of Doing Business. It's published by the World Bank. What does it measure? Unlike the old EODB, that is Ease of Doing Business, which only looked at a small local firm, Be Ready looks at entire life cycle of a firm from opening, operating to closing through three pillars. And those pillars are regulatory framework, public services, and operational efficiency. What they tell to the potential investors, it tells a company exactly how smooth the practical day-to-day operations will be. How can they get electricity quickly? This is very important in especially in the context of Pakistan situation. Is the tax system digitized and it is fair? How long does cross-border trade take? The next important index is Global Competitive Index under the category Operational and Business Climate. It's published by World Economic Forum. What it means to the investor, the set of institutions, policies, and factors that determine a country's level of productivity. Its core pillars like infrastructure, microeconomic stability, health, skill sets, product markets, and innovation capability. Why investors care about this index? While business ready measure the red tape, Global Competitive Index, that is GCI, measures potential. It tells a company whether a country has the structural organs or not, like a stable currency, highly skilled workers, and technological readiness to help a business scale up. Another important index under the operational and business climate is Human Development Index. This is published by United Nations Development Program. What it measures? A summary measure of long-term progress in three basic dimensions. That is, a long and healthy life expectancy, access to knowledge, that is schooling, and a decent standard of living, that is GNI, that is gross national income per capita. Investors care about it. Why? High value industries, with the considering technology, engineering, advanced manufacturing requires a healthy, literate, and a capable workforce. A low HDI score warns an investor that they may face an actual shortage of skilled local management and may have to spend heavily on trading or importing expatriates. The sixth index is Fragile States Index, that is also under operational and business climate. It is published by Fund for Peace, published alongside Foreign Policy magazine. What it measures? It assesses a country's vulnerability, collapse, or conflict by tracking indicators like fractionalized elites, state legitimacy, human rights violations, public service decay, and external intervention. Why the potential investor care about it? Because this is the ultimate worst case scenario metric. Even if country offers high profit margin, a terrible score on FSI signals that its civil war to a sudden regime collapse could physically destroy factory assets or result in the sudden nationalization of corporate wealth. Then, the fourth category is financial and cost risk. Over here, the index is sovereign credit ratings, that is, cost of the capital. It is published by S&P, Global, Moody's, and Fitch. The creditness, the credit worthiness of a country government, that is a AAA, and down to CRD. What information it provides to potential investor? It dictates the cost of doing business at a macro level. If a country has junk status credit rating, foreign commercial banks will charge exceptionally high interest rate to clear loans for projects in that country. It also serves as a massive warning flag for potential foreign exchange crisis and restrictions on pulling profits out of country. Now, coming to the summary, how the potential investors read the dashboard. The investors do not look at these indices in isolation. They compile them to build a comprehensive risk matrix. The investor dashboard may indicate if business ready and competitive indexes are high, but corruption is also high. The market is, in that case, the market is highly lucrative, but we must budget for heavy compliance and legal protection costs. In second case, if the rule of law high and HDI, that is Human Development Index, is low, our assets will be legally secure, but we will have to import highly skilled technical labor, or what normally means is expatriates. A country's international ranking operates like a health dashboard for corporate boards. When Japanese or global investors look at South, East, and South Asia, they use numbers to immediately size up operational bottlenecks and long-term security. To read the data logically, it is important to know that different indices use completely different direction of measurement. The higher is better indices, corruption perception index, rule of law, and human development index. For these, a score close to 100 or one means an investor sees top tier infrastructure and transparent laws. The second category is the lower the better indices. That is, fragile state index. A lower score indicates a highly stable country. A high score acts as a red flag to volatility. For all indices, the global rank field represents the standard competitive placement out of all assessed nations worldwide. For example, rank 1 is the best performing country in the world. A note on business ready index. As the World Bank World Bank continues its global rollout to business ready framework, countries are gradually being benchmarked across its multi-pillar ecosystem rather than a single score. This shift evaluates real-world practice efficiency alongside with regulations. Let's examine now comparative global dashboard. Here, the countries included are Singapore, India, Thailand, Vietnam, and Indonesia and Pakistan across the benchmark global metrics. Coming to corruption perception index, Singapore score is 84, its rank is C. It is the best country to invest. In Vietnam, score is 41, its rank is 44. So Vietnam is overall, its score indicates that is an acceptable. But in case of Pakistan, the rank is 136. That is one of the biggest issues. Coming to the Rule of Law Index published by World Justice Project, in case of Singapore, score is 0.78 and the rank is 17. That is excellent. Whereas India, Thailand, Vietnam, their scores are acceptable, and in case of Pakistan, the score is 0.39 and the rank is 125. Therefore, rule of index is not favorable and is unfavorable as far as Pakistan is concerned. So these are the areas where Pakistan needs to improve. That is, in case of to improve corruption perception index and rule of law index. So let's continue. The another important index is Human Development Index, and that is issued by United Nations Development Program. In case of Singapore, it is 0.948, very close to 1, and the indicates rank is colored as green, that is an excellent score. Thailand's score is 0.78, at the rank of 76, it is acceptable. Whereas Pakistan's score is 0.544 and the rank is 168, which is not so encouraging. Coming to Fragile States Index, Singapore score is 25.4. It is a very stable and a country with very low risk. Vietnam score is 56.2. It has moderate warning. Thailand, it's a warning profile, and Indonesia, it is also warning profile. But in case of Pakistan, the score is 91.7 and it indicates high alert and a fragile situation. Here we need to improve a lot. The global ranking of third in control of corruption and 17th in legal execution. Singapore is practically a riskless operational base. Japanese and global companies use it explicitly to house regional financial headquarters and coordinate capital deployments. The rising middle tier are Vietnam, Indonesia, and Thailand. These three countries show strong structural clustering. As far as Vietnam is concerned, it slightly outperformed its peer in curbing corruption at the rank 81 and offer a very resilient operational landscape. Fragile State Index is 56.2, making it a massive target for high manufacturing relocations. On the other hand, Indonesia shows a highly competitive rule of law posture within Asian ranked as 70. As far as Thailand is concerned, it leans heavily on its mature domestic infrastructure and a solid human development rank 76 to remain an unshakable manufacturing supply hub despite subtle political shifts. The scale plays India and Pakistan. This is where the diversion between raw consumer volume and institutional risk is most obvious. In case of India, India sits comfortably in the medium to high growth tier, while its demographic and scale metrics are top tier global rank of 130 in HDI tells Japanese technology and auto investors and global investors they still need to invest heavily in targeted local talent incubation and technical upskilling. Pakistan reveals an aggressive contrast. It has an immense market size. That's a plus point. But a low HDI ranking alongside an elevated fragile state score details exactly why onboarding new Japanese or global investors require deep trust building. Because macro landscape carries high friction, project must go above and beyond to guarantee ironclad compliance and long-term regulatory continuity to get signed off in Tokyo and around the world. Let us now also examine the leftover two matrices, and the number one is ease of doing business, which is now replaced by business ready business. Tax. The institution which issues it historically tracked by the World Bank ease of doing business index now permanently replaced by modernized business ready, that is B ready corporate flagship report. It evaluates country regulatory friction and bureaucratic speed across a firm's entire life cycle from opening a business, that is getting electricity, securing permits, paying taxes, to insolvency. It breaks them down into three pillars, that is, regulatory framework, the availability of public services, and the practical overall operational efficiency of enforcing those rules. This answers the question, how much red tape and administrative delay will we face or investor face just to get our facility legally permitted and running? As far as the cost of doing business concerned, say track collectedly through the World Economic Forum, regional investment data, and international corporate expense indices. Definitions it calculates the actual financial expenditures required to sustain physical operation in a country. This includes cost of real estate, जमीन की कीमत, कॉरपोरेट टैक्स क्या है, उसकी क्या परसेंटेज है, कॉरपोरेट यूटिलिटी रेट्स, बिजली गैस की कीमत क्या है, कम वेजेस क्या है फॉर मैनुअल एंड टेक्निकल लेबर, और ट्रांसपोर्टेशन कॉस्ट और लॉजिस्टिकल एंड फ्रेट shipping cost क्या है. Let's answer the question. Once the red tape is cleared, what are our monthly baseline operational expenses and will they erase our profit margins or not? We'll also examine here the dashboard again comparing Singapore, India, Thailand, Vietnam, Indonesia, and Pakistan. As far as ease of doing business, be ready concerned is top tier engagement benchmark at the pinnacle of digital efficiency, minimal opening friction, and flawless public service integration Singapore is at the top of the list. Second is high efficiency, that is of Thailand, with a strong historical score, extremely optimized custom procedures, and a single window setup for industrial zones. As far as Pakistan is concerned, the situation is challenging, facing instructional delays in utility, power, connectivity, and slower physical regulatory execution. As far as cost of doing business is concerned, Singapore cost of doing business is very high, extreme and permanent. Premier global wages, high cost of living, offset by zero individual taxes. So Singapore, it is not really good location for manufacturing industries, but it is also but it is useful for location of financial institutes and R&D center, etc., etc. In case of Thailand, it's a moderate cost, rising labor cost due to aging demographics, highly optimized, competitive logistical infrastructure. Pakistan, it's a low cost, ultra low cost, lowest baseline manual labor cost in the group, high inflation utility tariffs present a structural variable. So it is a mixed situation in case of Pakistan. So when the investor corporate boards overlay ease of doing business and cost of doing business onto this dashboard, a clear strategic trade-off emerges. The rule of capital balance. That is, for example, Singapore presents the near perfect ease of doing business alongside unmatched legal security. However, its cost of doing business is exceptionally high. Therefore, Japanese investors never built heavy manufacturing plants there. They instead deploy light R&D center, data ecosystem, or regional capital desk. Sweet spot alignments, that is Vietnam and India. These countries have aggressively optimized their ease of doing business profile via digitization, while preserving a highly competitive cost of doing business structure. This specific balance makes them prime targets for multi-billion dollar automotive and industrial and electronic industrial moves. Pakistan possesses an ultra low cost of doing business regarding human labor and raw material access. This makes it an incredibly profitable market for companies that can establish deep roots. However, because the ease of doing business metrics face operational utility and regulatory delays, a global or Japanese investor must build larger buffer zones into their timelines. This is why I highlighted earlier Japanese or global capital does not invest in flashiness. They use their corporate parameters to determine if a country's low cost doing business is worth the administrative navigation required to clear its ease of doing business framework. With this, we conclude our discussion on the today's subject, that is the foreign investment playbook. Please like, share, and subscribe this channel to receive the similar videos on different and unique subjects from time to time. Stay tuned and thank you very much.